This module brought together the financial and procedural aspects of Arizona's real estate closing process, focusing on how settlement statements, prorations, credits, debits, taxes, and recordation fees are handled to ensure fairness, compliance, and transparency in every transaction. Building on previous lessons about the closing process and possession, this section emphasized the importance of accuracy in accounting and the licensee's duty to verify that all funds and charges align with contractual and legal requirements. The foundation of this module was the settlement statement, also known as the closing disclosure. This document provides a comprehensive accounting of every dollar involved in the transaction, showing exactly who pays what, who receives what, and how the final funds are distributed. Governed by the Real Estate Settlement Procedures Act, RESPA, the closing disclosure ensures that buyers and sellers understand all financial aspects of the transaction before closing. Licensees are expected to review this document carefully to confirm accuracy and compliance, as required under ARS, paragraph 32-21751 R01 and Commissioner's Rule R428-1101A. The module explained that closing costs in Arizona are divided between buyers and sellers according to both contract terms and local custom. Buyers typically pay lender-related fees, title insurance for the lender's policy, appraisal fees, and recording charges, while sellers usually pay for real estate commissions, the owner's title insurance policy, and a portion of escrow fees. However, these allocations are negotiable and must be clearly stated in the contract to avoid confusion. One of the key concepts introduced was the calculation of financial adjustments, including prepaid items, accrued expenses, and prorations, because many property-related expenses, such as taxes, HOA dues, and insurance, do not begin or end precisely on the day of closing. Escrow officers must calculate each party's share fairly. Arizona follows the convention that the day of closing belongs to the buyer, meaning the buyer assumes financial responsibility starting on the date of recordation. This standard ensures consistency across all Arizona closings. The section also focused on credits and debits, which form the foundation of the settlement statement. Debits represent amounts owed by a party, while credits represent money due or previously paid. For example, the buyer's debits might include the purchase price and closing fees, while their credits might include earnest money deposits or seller concessions. The seller's credits often include the sale price, while their debits include commissions, prorated taxes, or loan payoffs. Understanding how these entries appear on the statement helps licensees verify accuracy and explain financial outcomes to clients clearly and confidently. Closely tied to these concepts is the process of proration, which ensures shared costs are distributed fairly between the buyer and seller. Common prorated items include property taxes, homeowner association dues, rental income, and sometimes prepaid insurance. If, for example, a property's annual taxes are $3,600 and the sale closes on September 30th, the seller pays for 9 months, $20,700, and the buyer pays for $900. These adjustments ensure neither party overpays or benefits unfairly from timing differences in ownership. Finally, the module addressed the handling of property taxes and recordation fees, two of the most consistent and legally significant costs in Arizona closings. Property taxes are paid in arrears, meaning they are always due for the prior year. Escrow officers prorate them so that each party pays their fair share, and any unpaid taxes are collected from the seller at closing to prevent a lien from transferring with the property. Under ARS, paragraph 42-17153, tax liens automatically attach to property when taxes are unpaid, making this process critical to clear title transfer. Recordation fees mark the final step of the closing process and are typically paid by the buyer unless otherwise negotiated. Once all funds are distributed and taxes cleared, The escrow officer records the deed and related documents with the county recorder's office, providing constructive notice that ownership has officially transferred. Recordation not only completes the transaction, but also legally finalizes the change in ownership. Arizona case law, including Watson Construction Co. v. AmFac Mortgage Corp., 1981, confirmed that ownership passes upon recordation, not upon signing or funding, making this step essential to lawful conveyance. Throughout this module, the central theme has been precision and fairness. Every calculation, adjustment, and document at closing must align with state law, contractual terms, and ethical standards. Licensees who understand how to interpret and explain closing costs build trust with their clients and protect both parties from disputes or errors. Key takeaways. The settlement statement or closing disclosure itemizes every financial aspect of a transaction and ensures transparency under RESPA. Buyers and sellers have customary but negotiable responsibilities for closing costs, which must be clearly defined in the purchase contract. Financial adjustments during escrow, such as prepaid items, accrued expenses, and prorations, ensure each party pays only their fair share. Credits represent money due or already paid, while debits represent amounts owed. Understanding both is vital for interpreting the closing statement. Proration applies to taxes, HOA dues, rent, and other shared costs, ensuring fairness based on the exact ownership period. Property taxes are paid in arrears and must be prorated or paid at closing to avoid tax liens transferring with the property. Recordation fees finalize ownership transfer and give public notice through the county recorder's office, completing the legal conveyance of title. By mastering the financial mechanics of closing, including settlement procedures, adjustments, and statutory compliance, licensees fulfill their fiduciary and ethical duties. This understanding not only safeguards the transaction, but also demonstrates the professionalism and accuracy that define Arizona's real estate industry.